Hello. I know it's been a while since I posted a video like this. Just complete breakdowns of my thought process. Just been a little busy with life, handling my shit. I'm still here, still kicking, and I pretty much want to go into a breakdown video for the session of Wednesday. Before I get into Wednesday's delivery, just a couple things that I just want to quickly hover over when it comes to how we started out for the initial week. If you do hear me sneeze, I am coming over a little cold. It was slightly too cold in my room. So on Sunday, because this is how our range is practically open, is on that Sunday new week opening. There's a gap down here in between this up close candle high, this down close candle low. Now I'm expecting that in some time, maybe later on, maybe today, we might eventually come down and fill this gap eventually. But at the current moment, it's not there. Now, going off of Monday, Tuesday, PA has been, very choppy, nasty, clusters, just terrible deliveries. But there will be sporadic moments at 9:30 where we have those nice upwards draws, such as here. And then we had another draw upwards before 9:30, and then we got a continuation of the downpour with a huge leg of displacement to the downside at 9:30 on this following Wednesday. So the key takeaways that led to Wednesday's idea is the fact that we've been traveling bullishly every single day, every single individual day. Price has went surely up, slowly but surely it went up. So these previous levels of buy side here, had to sneeze. But these previous resting levels of buy side here, such as the high here on Monday's day, that was taken and traded through, and that was something that I forgot to title myself as I'm going through the individual trading days. So Monday's high. And I keep notation of when these highs and things of that sort happen. What is the coloring? 10%. So Monday's high was traded through, and we traded right through that high at 9:30 on Tuesday. So I know I haven't covered any breakdowns for these other particular trading days. So I guess I'll just start from Tuesday and Wednesday, since these were levels that traded into PD arrays from the previous session high and or low if it does decide to gravitate itself down there. But no low has been taken from Tuesday yet or from Monday because of that gap. But we have taken highs of whatever the current session's high array was at that point of time before we fell and started trading back through it on the opposite end, but in the form of shorts. So I'll go over Tuesday fairly quickly. It's not a hard thing to cover. You understand that our draw on liquidity is clearly bullish. So if the market decides that it wants to continue going up, we have to follow the framework that presents itself so that we can get in sync with that upwards movement. So everything that I'm annotating and doing here is pretty much on the 15-minute time frame. You don't have to use the 15-minute time frame. I'm just using a time frame that just shows a clean amount of structure. Less choppiness, more draws on candles. The higher the time frame, usually the better the candles form. But when it comes to your entry, you don't want to just see massive one-sided candles. You need to see some type of retracement, draw lower, things of that sort, so you can get in sync with that candle's fractal. So the median point for the current moment is, the 15 chart, but on the lower time frame chart for that day, it could look possibly even better on the 5 minute and things of that sort. So just going over Tuesday, now looking at it off of the 5M, you can see how we had this level of sell side. Let's draw on this move lower at 29,770.50. After the market was pretty much sitting within this defined range, we sat here, we consolidated. Eventually, the market drawed itself lower around 3 in the morning. So within that London session, and we raid those stops below. So the market magnetized itself to the low at 29,770.50. Once that low was created and established here, and the pinpoint for that would be, oh, it's already marked. So this must be something that I just dragged further out to the left. To the right. So let me bring it back here. And now you can see that the data low for Tuesday was created at 29,743, flat after we sweep the 770 level. After the market did that within London, you see how the market is just slowly but surely drawing itself up. These old highs back here, which is our resting levels of buy side. If the market is going to draw itself up to these candles fractals, you can see exactly what these highs look like on the 15-minute chart and things of that sort, if you can find that cluster of PA. So right here, the high at 830, we trade above that high. We feel this imbalance here in between this candle's displacement in that range, and we trade through it while taking the old highs from the left-hand side of the chart. On the 30-minute, same range, same high. Nothing changes technically when you trade candle fractals, even when you look on the lower time frame. That is one of the biggest reasons why I necessarily don't have to go up to the higher, because I know what fractal that I'm trading within. So I understand why the candle is expanding the way it is and where it's more likely to go based off of that expansion. I just try to simplify it as much as possible. But that low for Tuesday is created down here, and ever since we made that low, price has never came back. Now, the reason why I have this green shaded zone here is because I'm just identifying the low of the trading range, or the short-term low that was pretty much created within the range, drawing higher and stretching it up to where buy side would be resting within that range, just so I have a clean shaded area of where the bottom of my identified trading range is, and then where the top, of that range is, based off of the concept of, if price is going to expand and create a swing low here, then we don't want to see price come below this old low, because that could possibly change our whole thought process on why it is that we want to see continuous longs. So we get that here. I myself took this short here at 9:30 to the downside. So I'll explain to you exactly why, it was that I took the short, and what caused me to get out of the short once I seen that our draw was back into the longs. So just counter trend trading to 9:30 and exiting my liquidity where I should properly fill myself before the new move going back up pretty much happened. So looking at this cluster of PA, you'll see that we had the low of the trading range here, And then the higher end of our dealing range is pretty much here at 930, which is this down close candle, long wick here. And I'm notating off that high and notating off this low. Now, when you stretch this across, and this was pretty much before we had the rallying at 935, 940, I have premium, well, not premium, but I do have TradingView subscription now to where I'm able to go back in time and view these legs. So that way you could get a entire thought process behind my way of thinking when I am executing, on these charts. So what I would do is probably pull it back just a little bit more before the move. Sorry, on 10x speed. So you see that's the low range. Once this plays out, it have that high. Turn the speed down just a little bit. Should I do like 2 times, 3 times speed? Select bar, remove that. Can add the PO3 if I wanted to. Candles bullish. Just play it. Hopefully that's not too quick. So at 9:30 we pretty much opened bearish. But before we opened bearish, you see how the market clearly wanted to take something first. So we sweep this old short-term high here at 840, and then at 9:30 we see the market come back into the range and close and trade within this red shaded area. All right. So we see our initial sweep after the market swept and pretty much broke this down close candles low at 925. I'm in for a short, and I'm taking it down to this short-term low here, made at 735. So as I'm going through PA and price starts to expand and do its thing and creates its ranges, I'm just journaling, notating things about price, notating the areas that we swept. How does the candles look, things of that sort, because I have to get some type of idea of where it is that it's more than likely to go next after certain conditions have been met, such as a sweeping of buy stops. So after that sweep of buy stops, you can pretty much see how the market just shot strongly up, rated, and then completely flipped, and we had closure below 930. So when we see that manipulative move going up, this is something that ICT would pretty much call a Judas swing. We have a manipulative move up above the 930 opening, which in theory you want to see a level or a particular area get traded into, which is usually our short-term highs within the range, because you want to see that get swept before we get our obvious draw where it is that you know that the market is probably more than likely to go. So remove this red shaded area. It closures, it moves up, and then we close below. It's continuing to respect the range and the draw lower. The low that was created pretty much at 930, it ends up continuing that trend and trades through it, closure below. And then when it comes to your old particular levels of sell side for your target, if you're getting in for a short, it would be these old lows and things of that sort back here. But really the next focal point is the range here that pretty much created this, but really the highest high end of the range, which is why I identify these red shaded areas like this, because I'm drawing my dealing ranges from where the swings pretty much start. So once I understand exactly where I'm at in terms of a trading range, I identify my swing of that range and I mark it in a shaded area, so I know where I'm at in terms of the higher end and the lower end of the range. And more of the story, you're just trading in between these shaded areas. Now after getting that manipulative move up, there are entries that you could take into this model. So the very first presented entry was after the sweep. So once the market swept, I believe that these entries are a lot more aggressive, but I usually like having my trades within a 20-point, within a 50-point stop. That's literally my predetermined set risk parameters. for any lot size that I do use, it's always a 50-point stop. So of course here, that's a very unnecessary allocation of risk because the market only traded about 5 points above the short-term high before dropping. So no reason to place that much risk on yourself. The whole purpose of trying to catch these entries is to eliminate the having of having to put too much risk on a trade. You want to try to find a approach to the marketplace to where you can make a lot but risk less, and sometimes that is very hard to do when you're wrong on your initial bias, but over time it is something that you can get better with. So about a 5 point stoppage above the short-term high, which is the rate on buy side, so 5.25, and then the market from there all the way down till we make our first actual correction in the market, which was here at 9:30. We draw up, create this retracement, and draw right back down, smacking through that 51 points on the target. Then looking over here to the left, we have another target for about 80.5 points, which this now becomes about a 1 to 15 risk to reward 80-point target. The market trades right through that at 9:34. And then last but not least, you have, of course, the low on the trading range. And then you also have the previous structured low from 736. So about 104 points here to 112 on this range. So not really a big difference to pricing got or gets to that low for a full trade. It's about 8 points. So you just roughly leaving about 9 points off of the table. You don't necessarily need it. Once the market swept right through this short-term low here at 29,850 flat, you exit your fill here. So you pretty much exit at buy side. You want to get out before those new inner workings of buys come into the marketplace and send the market back up higher. You don't want to get caught up in those sweeps. This is pretty much where you're more prone or bound to see reversals, is underneath these short-term lows and above highs as well. But then you also have to factor in things such as what fractal is pretty much creating this array. Is it a 4-hour higher low, a weekly higher low, a daily higher low, things of that sort? Because the higher the time frame, the more stronger that pullback or that reversal can possibly be. So you do have to be very cautious of where the market is, sending itself and trying to get to. Now, this low here was made at 29,826.50. Let's see what happened here. And this was pretty much that reversal. So after the market went down for about 104 points, exiting at buy side, it pretty much just traded and measure this range. So if you take it from this low all the way down to where it filled, so we went about 23.25 points underneath the 29,850 level. So that's about how much room you had to pretty much get out of this trade position in this counter trend short before the market went ahead and gave us the true move, which was buying. We've always been bullish just because the market sold off at 9:30. That never changed anything. So we did have a manipulative move happening on both sides of the marketplace's range, clearing high, drawing lower, and then excuse me. And then after that draw lower, we had a complete flip of the PA into, going back long. So that's how this candle ended up playing out. We went back bullishly This is on the M1. So in terms of like how I would trade this structure off of the M1, there's really nothing here for me. Um, no measured retracement, just a little sweep. But I like to be able to catch the draw back down and maybe trade into an imbalance and things that sort of get a deeper feel and then take the move up. But market just breaking above short-term highs and things that sort of respecting it as support and resistance. That's really all you need to take a measured leg into some piece of this buy. I ain't chase it. You know, I made my points of what I needed in this downboard. Before I get off topic, that was pretty much how we moved. And I think I did mention multiple entries. From my identification of this range, there are only two. You know, you had the sweep here at resting buy stops, and then you had the break and the break in market structure right here at this low at 29.879. And that right there would have been your last possible entry into that measured move lower, already on the M1. So me, you know, I'm always doing about, 50-point stops, things of that sort. But you already know that the market is drawing lower, so the odds of me having to use a 50-point stop here is probably be very slim to none. Could probably assess a lot less risk on just above the short-term high here, which would be about 28 points. And then you take it down to this low. So that's a 1 to 3 versus that damn 1 to 15 RR from the top of the key. But this is still another continuation of that handle going lower until it gets to the area where you're truly looking forward to go to. So one of the key takeaways I'll say about how I look at trading ranges is that I understand the legs. So when I see the first measured move of displacement happen and I don't catch it, which is okay, you just wait for the second one or the third leg and you get a continuation with where you're basing the trade to go, or your model to, seek, based off of where you found your first presented entry. And then if you can't catch the first presented entry into where it is that you want to exit, there are still other ways to get into the measured legs of price going lower or higher, so you can at least trade into that level and then get out. Very simple approach. So after we traded through that, did all of that, pretty much manipulated both sides of the range, stop hunted buyers and sellers. We seen a reversal and the market just full sent straight up. No real retracement for you to capitalize on and get in. The only real thing I can see here is us trading above this 941 high and retesting it here at what this is 944. So just some slight little imbalance here. Like that isn't in the entire range going up here, but came back down, retested, and market sends up. We already previously broken above, the old high. The market is creating higher ones, and as we continue going higher, that leaves us with the thought process or the idea behind how there is money resting above these short-term highs. So after the market corrected, pulled itself back up at 944, 15 right here at 945, that 15 opens. We come and retest the old high again, and price trades straight through what was the data high of this candle's range here at 29,939. And we trade through it right at 945, which would be the next opening of, the 15-minute candle, the 5-minute candle, I believe the 3-minute candle as well, and the 1-minute candle. So there's a lot of time frames that have confluence with this 945. And once you have those type of confluences, you feel me, the break, the retest, the trade above the old high, you see displacement, volume, everything is telling you like, hey man, we're going higher. These are the confluences behind the trade idea, and you take it. It clears that data high here, and we create a new price data high all the way up here. So it's about 55 points at the current moment. But now the new data high on that candle's range would be here. But for our target on where the price is trying to go would be 29,995 flat. And I thicken this level because that's Monday's high. And that's where we were drawing ourselves to on Tuesday. So Tuesday, and we end up clearing that high. So Monday's high was cleared on Tuesday. Tuesday, looked very crazy in terms of its PA, but it had a lot of strong movement going up. So trades right here into that orb, respects this measured leg here from this low, where we create our short-term low here to this high. In that zone, this is where you should be able to find your setup into the continuation going higher. So since we're on the M1, I can't scale down any lower than this. Might be something presented on like a 30-second chart, tick charts, but I'm not honestly trying to look that low into the candle to catch this move. If you can't see the presented opportunity on the M1 to get in sync, then you just leave it alone. Let PA do what PA does, and avoid taking unnecessary risk if you feel like you can't find the approach that you need to see to the market to get in sync. So it stretches up from here, creates the high here at 29,986, then comes all the way down back within this orb here at 953, and at the same time we sweep this short-term low here at 951 and create a measure move higher, shifting the market structure temporarily. So we had a temporary downpour, and then the market was trying to go somewhere initially, gets there, and then we flip, and now it draws higher. And then we trade right into that PD array. So looking at it from that perspective, the short-term low here all the way up there, that was about 106 points within this measured move up. So that's that for Tuesday. Now I could go into Wednesday, since that was the day that I pretty much just traded yesterday. And the move that I was able to catch on that was actually pretty nice. Just going over Wednesday's range, because I just covered Monday and Tuesday. But going over Wednesday's range with everything that had ended up happening, I'll just give you the entire points that was possibly could have caught. But from all-time high that was made at 3273.50, and this is going off of the data points that's on TradingView. I know for y'all, for you guys that trade props, I think the data might be slightly off on Top Step, so the data points aren't the same. But if you're able to find where that data point at for you, the structure should still look the same, just the data points are slightly off. So since I traded on this day, this one has a lot more better, markups, at least for how I'm journaling price as I'm going throughout the day. So we created all-time high here at 2273.50. That was done at 8:15 in the morning. So off that fractal of 8:15, or the 15-minute candle opening, we traded strongly up. Very strong aggression going up. It's all-time highs. There's no structure for you to base, this move off of, because there's nothing back here. It's all-time highs. Pretty simple. So the market needs to correct in order for you to really trade within all-time highs. It needs to be some type of measure move lower, because if we just keep going up, yeah, you could get in sync with the rallying, but since there's no measured room or retracement, it makes it kind of hard to try to stay in sync with the buying volume, if that makes sense. So since we created all-time highs and that market structure was shifting, there were two shifts that I pretty much identified. each on lower time frames. But there was one here at 3308 flat after we created all-time highs, and then there was another shift here at 2243 flat. So this is pretty much that shift in market structure on the 15, and then this is pretty much that shift in market structure that I was identifying off of the 5 minute. Our first identified break was at 835. And the entirety of this range, let me make sure this is right one more time, because I don't want to factor in the things that are being done here on Thursday. Just want to focus on everything that's being done on Wednesday. So from data high all the way to the low, that's about 504 points. So before 9:30 and then getting into sync with 9:30's displacement, because that's the open of the stock exchange market, the market already moved over 504 points within 2 hours and 15 minutes. At 9:30, I caught a good portion of that move going down, and I was able to capitalize before we had that correction going back up and creating this range here, which I'll go through into how we ended up getting to that 29,876 level, because my projection was for us to go down. That is what I thought the market was going to do, based on my analysis. Just to show you I'm not lying, this is portions of it, of what it was looking like beforehand and things I had identified and marked up and the levels that I was calling for. And then this is the after that first shift there at on the 5 minute. All-time highs, about 72 points of maximum risk. If you would have entered in here and held it to that target, about 490 points. I wait till 9:30, so I got in closer to 9:30 and held it all the way down until it had the first measured correction, and I believe I got out before this. But it still did exactly what it was that I pretty much wanted it to do. Now that we know that the market has dropped 504 points, we had our first break in market structure on the 5 minute, and then our real threshold being broken for the 15 here. And the market at 9:30 just traded through old levels of support. Huge measured displacement going straight down. And then we created a short-term low here at 10:30. When that low is created, rinse and repeat, the low made at 10:30 all the way up to the highest end of the dealing range within our consolidation, which is 6 p.m. And I dragged that across. I could put a midline through it so I know where I'm at in terms of consequent encroachment, or just 50% of the dealing range. Above it, this is where you would find great opportunity to trade back into premium prices, and below it is where you would find great trades to trade into discount coming back up. So since we're on the sell side of the curve, you're really not too much focus on primarily what's happening on the buy side of the curve, but we do need to understand what's happening in terms of a retracement, because we need to see the market pull back up in order for us to get in sync with it going back down. So I'm looking at price on the 15 and just looking at the measured move. If I just start breaking down this range, you see here how we have this short-term high here, or really this high here that started the entire swing going down or correcting back down at 10 o'clock. So the 10 o'clock opened, created a wick, which created a short-term high. So we have high, higher high, lower high. This is a short-term high. That short-term high is being marked off, and that is the high of the 10 o'clock at 3,099.25. And then from that 10 o'clock high, we obviously went down lower, and 10:30 we ended up creating the low of this range at 29,876 flat. Now from that low, the market tried to get down to that low again, but it missed it. It didn't hit it here. This is 29,877.25. So it missed it slightly by like a point and a half, or a point and a tick, and then went up, created a higher low, and then just continued to go up until it ended up getting into that buy side objective here of 30.99.25. After that sweep, you see how at the top of the range here, um, the market traded as high as it could possibly go here before falling again, taking short-term lows here. Filling in this orbs range. This is being done on the 15th. And then we see here how, the market is pretty much respecting that lower draw. It's failing to go higher. So a little short initial sweep in between here to here. That 715 and 845. But the PA is maintaining, its bearishness. And you look for it to trade under the low. So opportunity presents itself within the range. Probably could have drew a fib from this high here to this little short-term low. And let me extend the lines off of the right and drag this out ever so slightly. And you see right here how we have multiple body closes and a structure being held on the 62%. And the 62% for me, in between the 62 and the 70.5, is literally a golden zone within the Fibonacci retracement tool. So that 62 here was very much a very nice indication that you could get into a short here within the retracement of that range. Most amount of drawdown that you would have went into, where you would have to place your stop, would have been 67.50 for the maximum amount of assessed risk. But really, if I'm doing everything within 50-point stops, that fits my trade parameters of what I would like in order for me to take a trade. So let me just bring that down slightly so it hits 50 on the dot. Mouse is very sensitive. So I can't get it, and that's fine. But that fits my trade parameters with a maximum stop of about 67. It fits within my parameters of having a 50-point stop. And the most amount of drawdown that you would have went into off that trade was about 19. So you would have went into only about 19.5 of drawdown, and you wouldn't even have to worry about it, because once it starts to break down, trade underneath the short-term low here identified on the 0, you can now, become risk-free. You no longer have to worry about that drawdown, and now it turns into like a 100 RR on the trade because you broke even, almost a 500 RR on the trade. First projection level on the fib, which is the negative 62 for about 216 points. And it breaks itself down underneath that low that I was calling for about 194 points, and you get your fill. So that's about a 778 risk to reward. To the first projection level here is about 867, and then after we cleared this little short-term low here from the previous range, it wasn't a data low or anything of that sort. It's just a area of sell side being targeted, and we trade underneath there. Orders are collecting, so this is pretty much a consolidation. And when you see consolidations, you think of an holding pattern where the market doesn't know what it wants to do next, and this is what you don't want to be in. But you usually see this a lot when we get underneath short-term highs and lows. This is where your areas are more prone to have reversals. But that doesn't mean that you cannot have a continuation of, PA as well, to where it looked like this. It'll come down, draw itself down, come back up, consolidate, and then move back down and take that low. But a lot of the times when you see reversals after clearing, a low such as this sort, the market will respect it, bottom out, and then break a market structure. Let me take this PL3 away. And break market structure and retest that market structure, and then pretty much go up and fill all these imbalances and things of that sort, and take these short-term highs back here, and now we end up here, and that candle's range expands like this, and that would be the short end of that range and the high end of that candle's range. So see how it played out. It's literally where the reversal happened, and it came back up and started filling some of the range. And this is pretty much where we end up now, in terms of the PA. So we'll see in due time what Thursday will present for itself and hold. And that's pretty much it. So hope you guys were able to take something away from this video. It's been a while since I've actually posted, trade content in terms of like market analysis. So it feels good to be back. I've just been handling things and just making money. So that's all I got for you guys. So far, all I covered. Just giving you a summary is Monday, Tuesday, and Wednesday. The trading week is still concurrent, so cannot give you any assessment of Thursday or Friday until that data is done and set in stone. Then I could give you my feel of how I felt trading on that particular day. Since I've already covered 3 days, I'll probably just do Thursday and Friday, and then do a recap on how the entire range looks now. But I won't really necessarily go over every single individual trading range because I already covered 3 of them here. So yes, that is all I got for you guys. Enjoy and good luck trading.